Hello, welcome for joining us today. We're super happy to have our friends at ChainLink here. Big shout out to Paula, who's a friend of mine and partner in this effort. And so we're super happy to have them here. I think we did one some time ago, but lots of news to share with you. We're broadcasting live from Park City, Utah, where I am, and Costa Rica and Oregon. So please note that if you have questions, we have a lot of people coming on today. So if you wouldn't mind posting them to the chat box or the Q&A, we'll get to as many as possible. Also, if after you discover what you discovered today and you feel like it'd be interesting to others that you know, you're super welcome to connect directly with our friends at ChainLink and follow up with them directly with others as well as yourself. We'll make sure everybody gets in touch with each other. We're also recording this, and then hopefully we'll post it to the ChainLink website or somewhere where you can view it and share it with others. So we'll keep everybody apprised of how that's going to happen post-webinar. So with that, you guys want to do just a short backgrounds and then we'll get right into it? James, am I going to give it to you? There you go.
Yeah, I can start. Hello, everybody. We'll give a couple minutes for everyone to join. Andrew Hoppin and I are business partners. We'll get into the ChainLink and Amphibian partnership in a second. A few fun facts about us. We've both spent a lot of time in New Zealand. We both spent a lot of time at UC Berkeley, and we both have spent a lot of time running digital assets fund of funds. So that's a little bit of background about us. I grew up in New Zealand, studied finance and psychology at UC Berkeley, University of Auckland in New Zealand. I was fortunate enough to win a green card in the lottery, which led me to run a digital banking event back in 2012, 2013, which is when I first got into blockchain and digital assets and crypto, and have been in fintech or finance crypto since then. And we'll be getting more into what we do and where we see the space going later today. But we'd also love to hear from everyone here where they're calling in from. So feel free to post in the chat. Passing to Andrew.
Thanks, James. Yeah, Andrew Hoppin here out in Oregon. And I have a multi-decade career as technologist in a bunch of different contexts. First at NASA, I was a space scientist, although maybe not a very good one. So it got me quasi-technical though. And I moved on quite quickly to government and politics and worked on the technology team of national presidential campaigns. And then in New York State as the chief information officer. And thereafter started a govtech company, which I was able to build up and exit to a large PE firm. And so all of that was about managing a lot of technology in very traditional ways. And circa 2017, I got very inspired about a new wave of technology capability called blockchains, which we'll get into in great depth today. And that's what has been my entire focus of my brain ever since, and now in the context of a professional investment firm.
Great. Thanks, guys. Who wants to start off here? You want to go ahead and jump into the deck?
Yeah, absolutely. And also, welcome everyone who's just joining us. We tend to speak pretty quickly. So what our plan is, we've got 3 key sections that we're going to go into today to help share where we see the digital asset space moving, as well as how to bring it into an all-weather portfolio, and then also risk management and due diligence. So at every step of the way, we'll pause to answer questions, but we also speak quite quickly. So if you're okay with that, put the word fire hose in the chat if you're okay with me being a little bit of a fire hose with this slightly strange New Zealand, Costa Rica accent, mixed in with a little bit of American twang with the 11 years I spent in the US. And we'll get started. So our intention for the day is to talk about an all-weather portfolio in regards to digital assets. And we're in this year of 2023 when things are unfolding in such a rapid manner like they never have before, at least in my lifetime and certainly in most people's lifetimes that I speak to. And so our focus today is digital assets have outperformed every major asset class since 2009, but they have also been the most volatile. And so as we enter this new era with digital assets 2.0, how can one build a all-weather portfolio that includes digital assets targeting superior risk-adjusted, uncorrelated returns to other assets and multi-weather market conditions that hedges tail risk, catches potential upside, especially, particularly as we enter a new potential crypto cycle, and it becomes part of the growth assets in a well-diversified portfolio. And so there'll be three sections we're going into today. One is digital assets 2.0, the mainstream era. So how do you have a deeper understanding around it, more familiarity, see where the puck is heading, and become aware of investment opportunities? The second one is all-weather portfolio construction. How can you start to think about digital assets as part of a all-weather portfolio? And last but certainly not least, how do you think through regulatory updates, compliance, risk, evaluations, and approaching diligence and risk management? And at the end, we'll actually be sharing with you something we've been working on for years, which is our 92-point questionnaire and checklist, which you can use if you decide to invest in the space to go and vet other funds or other projects. Welcome to those who are just joining us. And of course, anything in this presentation is for educational, informational purposes only. It does not constitute financial investment or legal advice, etc., etc. And so with that, I'm going to pass it over to Andrew, who's going to talk about how we got here.
Great. So I'm Andrew Hoppin again. I'm one of the co-founders of ChainLink Capital Management. And next slide, please, James. ChainLink Capital has been in business since the very beginning of 2018. And we do one thing and one thing only, which is very specialized. We run hedge funds of funds that invest in digital assets and blockchain technologies. And we're the second oldest organization in the world, second longest track record doing that since the beginning of 2018. Our focus is basically making a long bet on this industry. We run primarily venture oriented strategies and some other long strategies to give you exposure to this technology and the teams that are building this technology that we believe is going to be such a big deal in the world. And I'll move on to the next slide, please. We've done very well. We've won lots of awards, certainly made plenty of mistakes along the way, but we are really honored to be here longer than almost anyone else doing this in the way that we're doing it. And in particular, most excited, next slide, to last year have teamed up with an amazing group of people from Amphibian Capital, led by James, to address a complementary opportunity to what we've been doing for more than 5 years, which is, while we focus on long and venture assets, we've realized through the 5+ years we've been doing this that there's an entirely broader opportunity set available in quants and market neutral strategies in the space. So we teamed up with Amphibian and James in order to address that broader opportunity set. This aggregate hybrid team is the best team that I've ever worked with in my multi-decade career in technology. I'm incredibly honored to be here and to be partnered with Amphibian. Over to you, James.
Great, thank you, Andrew. So the idea with Amphibian was, one, how do we start to create a vehicle that can not only run the different cycles within crypto, but can also benefit from the volatility? Given digital assets since 2009 have outperformed every major asset class, but also been the most volatility, how could you build a suite of products that can truly benefit from that? And then as a team and all the people we've been able to attract to work with us, how do we then repurpose our profits as GPs to then go and fund the world we want to live in, especially for our children? And so that's really been the mission behind the company. And through that, we've also decided that we're not only going to be a fund of funds, we're also going to help develop the ecosystem. And so we've gone and built countless partnerships around the space, around different technology providers, institutional investors, family office investors, underlying funds, VC firms, underlying projects, etc. We've really built this huge consortium of players in the space to help really drive the industry forward. Thank you for the question that came into the chat box around ChainLink Oracle. We'll answer that shortly. But we're going to go into 3 sections today. At the end of every section, we'll pause for Q&A. Like I said, I am a little bit of a fire hose, so bear with us as we go through things relatively quickly, but we can send you these slides after, etc. So we'll go into 3 things. 1, digital assets 2.0. While we believe we're entering the mainstream era. 2, all-weather portfolio construction with digital assets. And 3, risk management and DD. So as we get into that, let's look at what investors face in 2023 today. So the landscape is changing and traditional portfolio models, we believe, are breaking down. So if you look at what happened in 2022, when you had an inflationary bear market, we start to saw the correlation between stocks and bonds rise to 0.7. We saw in what was traditionally, quite a well-diversified portfolio, a 60-40, negative 17% return. So not only did you have low downside protection, you also had low upside. And so our belief going into 2023 and beyond is diversification is key to mitigating risk. The reward needs to be worth the risk, and uncorrelated growth options are needed for a truly solid, sound portfolio. The second thing that's unfolding at the same time as that is the world is growing exponentially. In a microchip that's used in so many of the devices we use today, in 1970, you had 1,000 transistors in the microchip. Today, it is 50 billion. On top of that, we're consuming more data and creating more data than ever. According to the US Chamber of Commerce, 90% of the world's data was created in the last 2 years. I'm sure many of you are watching this on some sort of smart device, whether it's a laptop, a tablet, a computer. And so I imagine for so many of you, you didn't have those devices, a few years ago, or a decade ago, or 2 decades ago, but it's something you use every day. And so while you may not fully understand exactly how the electricity works and the smart devices work and all the different components and the apps and all the different pieces, I do imagine that within your portfolio, you have some sort of exposure to energy and or tech in your portfolio. And so in the past, there was this adage that Warren Buffett famously claimed that he didn't invest in things he didn't understand. But now in 2023, even Warren Buffett is investing in tech. In fact, as of the end of January, 43% of his portfolio of Berkshire Hathaway was invested in just 5 stocks. And so through AI and a bunch of countless Moore's law technology that's growing exponentially, humans are struggling to keep up with machines and the rate of change, and the world is adapting rapidly. And it's the same with investors. And so the takeaway that we believe in 2023 is that investors need expert partners, not to be experts in everything. On top of that, you also have this unprecedented uncertainty, and there is a lot of different noise. And so how do you focus on that? And so our takeaway for this is to hedge tail risk, but then really double down on the long-term trends, focus on the signals, and let go of the noise. And so recapping those takeaways, which are very important because it's going to help dictate where we go with this presentation, is the reward needs to be worth the risk. Investors need expert partners, not to be the experts in everything. It's important to hedge tail risk, focus on the signals and long-term, and let go of the noise. And so today we're going to get into the solution that we believe is very viable to a 2023 investor, is building an all-weather portfolio that includes digital assets, targeting superior risk-adjusted returns that are uncorrelated with other assets across multiple weather conditions, captures potential upside, and becomes part of the growth assets in a well-diversified portfolio. So part 1, digital assets, the mainstream era. A very quick journey. I was very blessed to study at UC Berkeley, study finance, and then in 2011 moved to New York, and I ended up running Net Finance, which was one of the leading digital banking events in North America. And through that, I found out about blockchain, I found out about digital assets, found out about Bitcoin, etc. And in 2012, 2013, when it was starting to pick up in these circles, I started looking at investing, but I wasn't familiar with it. I didn't fully understand it, and I decided not to invest. But we also had an investor who's now an investor in our fund, who name I'm not going to mention for obvious reasons, but we'll call him John Doe, who was there at the same time as I did, but he did choose to invest and he did decide to dive deep. And so he ran through 3 cycles. He got in early, he realized the technology, he made a lot of very smart decisions. Now he's worth 9 figures, and now he just invested, a bunch of those assets into our fund. Whereas with myself, I missed the 2013 cycle. I had to learn the patterns in 2017, go through 2021, and then out of that, I decided to create a fund because I had so many of my friends and family in 2021, and over 500 of them in a Telegram group asking me what I was doing. And I decided, rather than people trying to figure it out, I decided it was time to partner with ChainLink and build the ultimate product suite we believe in the digital asset space, and hopefully start to catch up to my friend who started a lot earlier than I did. And so before I pass it to Andrew, just quickly as we refer to digital assets, I want to become very clear on the definition today. Digital assets are valuable items or information that exist in electronic format, such as cryptocurrencies, digital files, and ownership records that can be stored and exchanged electronically. Like I said, we're going to send you the slides later if you want them. I'm going to go through quickly today so we can answer all the questions. As I pass over to Andrew here, we believe digital assets are now entering into their 4th era. So much like the Bitcoin era, when I was running Net Finance, we saw huge gains in Bitcoin. We then moved into the Ethereum era, where we really saw the top of the cycle happening in 2017. We then had the last cycle, the early app era, digital assets 1.0. And we now believe we're moving into the mainstream era, digital assets 2.0. And Andrew's going to talk about why we believe that is. Over to Andrew.
Thanks, James. Yeah, next slide, please. So we believe we're at an inflection point in this industry, and we're calling it digital assets 2.0, and we believe that it is going to be the beginning of the most potent cycle to date in this industry of digital assets and blockchain technology. But perhaps more important than our conviction about it is the conviction of investors that are well regarded by the smartest money in the world, in the most entrepreneurial and innovative place in the world, Silicon Valley. So I had the opportunity to be on Robert Scopel's show back when I was a GovTech entrepreneur many years ago, and it really made me sit up and take note when he tweeted this in May of this year, saying that the people that he speaks with in Silicon Valley are making huge investments into this space. And in fact, far from it being that AI has taken the attention away from blockchain technology in terms of making those investments, it's in fact catalyzed interest in this industry. And for reasons that I'll get into, we believe that these technology revolutions are complementary and in a position to catalyze one another. Next slide, please. So what is this 1.0 versus 2.0 that we talk about in these two last cycles? In the cycle that we launched ChainLink Capital in at the very end of 2017, we were in a cycle, frankly, of hype and speculation, and where a lot of the people that were doing in some cases, the best work technologically in the space were very dismissive of the need for regulation. We were also in an era where the only real use case for these technologies that had been proven out was the store of value use case, the Bitcoin use case. Everything else was perhaps a good idea, but absolutely not proven out. And some of the reasons why it was not proven out is because there was not much institutional investment. It was really independent, high net worth folks, in some cases, people like James's friend and now investor in his fund that had gotten in early on Bitcoin and Ethereum and who now were independently wealthy. And there was some early stage venture capital as well, but there was not large institutional participation in this industry at that time. And then finally, what we were all investing in at that time were really the primitives. They were the building blocks. They were the technologies that were not yet mature that we needed in order to be able to do interesting things with this technology. There were challenges in terms of scalability and security, cost, and interoperability. Fast forward to today, and the inflection point that we believe that we're at now, which we call Digital Assets 2.0, we see very mature companies that used to be plucky upstarts like Coinbase, which are now sought after by literally the largest asset managers in the world, like BlackRock. BlackRock and Coinbase famously have partnered on BlackRock's Bitcoin exchange-traded fund application. We also see a myriad use cases that are being proven out that are actually demonstrating product market fit, such as real-world asset tokenization. This is the tokenization of stocks and bonds and other real-world assets in order to make them more liquid and more easily tradable globally at lower cost and more efficiently. And we see Web3-based alternatives to traditional closed Web2 applications in areas like gaming and e-commerce, which are starting to take off in terms of their user adoption. We also see the largest traditional finance companies in the world. It's not just BlackRock, it's Fidelity, and it's Invesco, and it's WisdomTree, and it's on and on. Some of the largest asset managers in the world are now heavily invested in this space. So we believe they are truly the smartest money, and the fact that they are moving now, perhaps before there is popular wisdom, that it is the time to move heavily into the space. We think that that's important to pay attention to. And then finally, why is all this possible now? Well, one of the reasons is that the technology is actually ready for prime time, we believe. The underlying primitives have been built. You can now have blockchains be specialized in doing specific things and then work together interoperably to deliver the outcome that you need, which is an important stage of technology maturity. Next slide. So we look at these three different complementary technologies are converging: the digital assets that James defined, the blockchain technologies that are the way that we can run decentralized, trustless transaction networks globally without needing a centralized institution in order to make that happen, which often, but not always, involve digital assets or tokens to support the operation of those blockchain networks. And then artificial intelligence, which is both a key catalyst in terms of the maturation of these technologies, can help them develop faster, but also a forcing factor for the utility of these technologies in a way that I get into in a minute. Next slide. So digital assets we think are great for liquidity. Basically, you can trade things at lower cost, more transparently and more efficiently, with less regard for borders and other silos when you have a digital asset and a token representing a real world asset in many cases And this opens up myriad use cases that would just not have been cost effective before, particularly in the tokenization of real world assets. Blockchains we think of as being fundamental for identity and provenance. So if you want to know what actually happened, or who somebody actually is, or what something actually is in the real world, blockchains, we think, are a fundamental technology to being able to do that, because they create an immutable record that is available to anybody in the world of what's so. This is particularly important with the advent of AI, which is making it much more difficult to actually discern truth from something that is made up and faked, even at the level of your personal identity. We'll get into more about that. Next slide. So long story short, this is why we think assets under management from major companies to the tune of $36 trillion that are managed by these companies are making major investments in this space. We think, again, they're the smartest money that you could possibly hope for, and we see them moving en masse right now. Next slide. So a little bit more about why. I mentioned technology maturation, real world applications, and regulatory progress. Next slide. Technology adoption. We have faster adoption of blockchain-based wallets than we had in the Web 1.0 era of the original internet. We're ahead of plan, if you will, if you believe that Web 3 is the third generation of the internet for end users. Even though there are significant usability challenges, we're still ahead of where the analogous timeframe was with the adoption of Web 1.0. Next slide. Really importantly, developers are, we think, the benevolent canary in the coal mine. What they are spending time on with their creativity, energy, and intellect is what we think will end up being breakthrough technology and worth investing in. So if you want to be ahead of the curve, pay attention to what developers are doing. And their participation, as measured in a number of ways, is going exponential right now in blockchain technology and digital asset space. Next slide. Real world use cases. So these are a number of ones that we're excited about, particularly given our focus as early stage venture investors on the ChainLink Capital side. I'm just going to give very brief examples of the top 5 here in the top half of this circle. Next slide. Payment settlement. So you buy something with a credit card. The credit card company ultimately needs to interact with a bank. The money needs to get, at the end of the day, to the merchant. It goes through banks, and it goes through payment networks, and it comes from you, the consumer. Visa, and what we think is a very significant event just this week, announced that they're now going to enable that sort of settlement to take place with a blockchain-based stablecoin. And we believe, and Nick Carter has recently said, that portends that is going to become the de facto interbank settlement solution for payment card networks. Next slide. I mentioned real world asset tokenization. So these are primarily, for now, financial instruments, right? They're stocks, they're bonds. Larry Fink famously has said that this is the next generation for securities, is the tokenization of securities, but it does also other real world assets, real estate and what have you, that can be tokenized and thereby managed in a more secure way, and in fact, made more liquid, easier to transact. Next slide. Identity and AI safety. I mentioned this before. We think it's really telling that Sam Altman, the CEO of OpenAI, of ChatGPT fame, his other company is a company called WorldCoin. And WorldCoin's mission is to provide a blockchain-based proof of humanity so that you can prove that you are in fact a human and not an AI bot. This may seem like a little bit trivial today, but it is fast becoming fundamental, we believe, to your ability actually to operate as a human in this world, to be able to prove who you are and that you are in fact human, because it's too easy to fake it in any other way. So whether it's WorldCoin that wins at this or somebody else, we think this is an absolutely fundamental use case, an example of why AI is actually driving the necessity of blockchain technologies. Next slide. PayPal. So PayPal by itself has more users than have ever used the Ethereum blockchain, which is the #2 blockchain in terms of adoption and use in the blockchain tech world. And they now have launched their own stablecoin because they see a massive market opportunity. They believe that always-on programmable payment rails, which is one of the things that blockchains, and particularly the Ethereum blockchain, can do very well, are a game changer for their business. And that's why they're doing this. And the potential reach from their adoption is exponential in terms of its impact on the industry. Next slide. finally, this is not just sort of financial tech use cases or existential risk AI use cases. This is also just the day-to-day of being a consumer in a capitalist society. A number of major global brands, Mattel is the example on here, are adopting blockchain technologies and Web3 apps through portfolio companies of ours like Magic in order to be able to build a better relationship with their customers and providing better tuned incentives for loyalty. And we think that this is one of the things we're going to see in the digital asset 2.0 era that was talked about for a long time, but not actually seen at scale in the digital assets 1.0 era. And we're very excited about it. Next slide. Regulation is fundamental. It's a blocker to institutional investment and therefore maturation of the space. And it can also be a great enabler. And the leading lights of this industry, if in case there's any doubt, absolutely believe that regulation is important and necessary and good. And it needs to be nuanced regulation in the belief of most of the community that works in this industry. There's a general belief that the SEC in the US has overreached and been a hindrance to this industry, whereas most other major governments around the world at this point are rolling out the welcome mat and inviting entrepreneurs and investors to work with these technologies in their geographies. But even in the US, which obviously is a fundamental market to the success of the industry, we're seeing the tide turn. We're seeing, particularly in the judicial system, just in the last couple of months, a number of really fundamental decisions, which we think are going to create a perception of a much lower risk environment for institutional participation in the industry in the US. One was the fact that a court said that the SEC had to review its rejection of Grayscale's application to transform its Bitcoin trust into a true spot Bitcoin ETF, which again would make it very easy for investors to buy and sell as you would a stock Bitcoin. And we think that that is going to be the opening of a flood of Bitcoin spot ETFs if that gets approved, including the ones proposed by BlackRock and Fidelity. Next slide. And then just this last week, there was a court case where the judge asserted that both Ethereum and Bitcoin are commodities. And we've had a number of examples of this, but basically the judicial system so far seems to have taken issue with the SEC's characterization that almost everything that is a digital asset is a security, and instead said, no, they're commodities and they need to be regulated as such, and particularly Ethereum being the big one where that's been in question. This opens up a much less risky space in terms of its perception to investors when you have the judicial system coming in and starting to push back on the SEC. Next slide. So gone through these four eras, as we conceive it, we believe that we're at the beginning and a true inflection point of the fourth one, the digital assets 2.0 era. Thanks, James. Go ahead.
Great. Thank you, Andrew. Also acknowledging Rob for your question about input on your co-intellectual property portfolio. We'll be sharing a little bit later around how we collaborate in a deeper way. High level, ChainLink has approximately just under a third of the GP within Amphibian Capital. We have a smaller percentage within their GP, and we're collaborating deeper and deeper day by day. Andrew, anything else you'd like to add on that besides before we get into the product suite?
No, but just in case, because there was a question about it, just in case there's any lack of clarity, we are ChainLink Capital. We run digital assets, hedge funds of funds. We have no relationship to the ChainLink Oracle or protocol or token, although we're big fans. When we created our firm, ChainLink, the protocol was not well known. It was 2017. But today they're extremely well known, much better known than we are, but we do extremely different things and have no relationship with them.
Hey guys, would it be okay to mention now, if relevant, the recent announcement about how to calculate the accounting in terms of maturation of the business? How their Bitcoin is treated from an accounting perspective, tax, so forth in the US?
Sure, I can jump into that just briefly. My understanding is, and I'm not our CFO to be clear, but my understanding is that we're moving to an era where you can actually treat Bitcoin and other digital assets on your balance sheet if you're a corporation reporting under GAAP accounting principles. And rather than the legacy status quo of needing to report losses but not being able to account for gains until you actually liquidate an asset, now being able to account for it as you go at fair market value. And yes, we think that that is a significant contributor to why many major corporations are putting large amounts of Bitcoin on their balance sheets. It's a hedge to fiat currency. There's tremendous potential upside, many people believe, relative to the potential downside. And now there's going to be more, equal accounting treatment with this asset and other types of assets that you might have in your treasury.
Perfect. Thanks for that.
Great. So we just threw a lot at everybody. Let's take a slow, deep breath quickly before we go to the next section. Okay, thank you. Let's get into the next section. So the next section we'll be referring to how do you now take all this data and how do you start to incorporate it into an all-weather portfolio. And so just for definition's sake, what is a traditional all-weather portfolio? Its originally term came from Ray Dalio. An all-weather portfolio is a diversified investment approach built to deliver consistent performance across market conditions, combines various asset classes, stocks, bonds, and alternatives in a balanced manner to reduce risk and ensure steady long-term growth. Well, just like 60/40s, what happened to the traditional all-weather portfolio in 2022? Well, it performed even worse. And so you actually had low downside protection and low upside. And so in 2022, 2023, as things evolve, investors have nowhere to hide. And it's very important to really look at our portfolio mix and how we start to approach those earlier lessons we referred to around the reward needs to be worth the risk. Investors need to be expert partners, not to be experts in everything. It's important to hedge tail risk, focus on the signals, and double down on long-term trends, not the noise. And so we're going to get into how to build an all-weather portfolio, including digital assets, that'll target superior risk-adjusted, uncorrelated returns to other assets in multi-weather market conditions, captures potential upside, and is a part of the growth assets in your portfolio. So the first piece around this before we get into the portfolio construction is actually understanding emotions inherent in digital asset cycles, because whether someone's a retail investor, whether someone's a family office or an institutional investor, this is still impacting us as human beings. And so looking at the numbers of these cycles is one thing. It looks easy to look at it on paper, but going through cycles or going through as we move to the mainstream era is a whole other piece when we look at our psychology. And so being an effective investor in 2023, I was fortunate enough to study psychology and business in college, is it requires a combination of emotional intelligence as well as intellectual intelligence. And so during these cycles, we can have all sorts of emotions coming up, but it's really important for us to understand how those different emotions play in and noticing those emotions and not reacting to those different emotions. And so just like any other market, trying to time the market can be very, very costly. So 52% of the S&P 500's best days since 1993 were in bear markets. And if you missed the 20 best days since 1993, your portfolio would be 73% less. And so what happens in blockchain, for people who have experienced it, most people, like all my friends and family in 2021, most of them were coming in belief, thrill, euphoria phase. And by then it's far too late. And so when you're seeing mainstream headlines where it's bullish around Bitcoin and blockchain and all these other areas, oftentimes it's too late. And so in blockchain digital assets, there's even something called the Fear and Greed Index. And so historically, the optimal times to invest in digital assets is when there's apathy, when there's fear, when there's doubt, etc. And you need to look at the underlying trends. And this is one of the biggest things I learned from our investor who started in 2013, is it's letting go of the noise and focusing on the signals. And by the time most news hits mainstream press, it's oftentimes too late. In the 2017 cycle, by the time CME Bitcoin futures had started, it was already past the top of the cycle. Elon Musk went live on Saturday Night Live at the first peak in 2021, and then ProShares launched the first Bitcoin-linked ETF at the top of the cycle later in 2021 in fall. And so where we see digital assets now in their life cycle is what Gartner would call the trough of disillusionment. And so it wouldn't have felt great to invest in NASDAQ 2002 in tech stocks either. But if we look at what happened, this is the potential that this kind of asset class may have. And one of the things that ChainLink's learned, have been in a fund of funds for the last 5 years, is they found that investors who actually came in during bear market cycles outperformed investors who came out later times by 2 to 4x. And so it's very important, based on historical cycles, to not necessarily try and time the market, but understand that based on emotions of psychology and based on historical data, now is actually the time when the highest chance of risk-adjusted returns, superior risk-adjusted returns, is available to investors who are long digital assets. So getting into step number 2, now we've talked about the psychology. The second piece is, how do we now slow down and how do we take a more measured approach to this asset class? And how do we have this consideration around evolving our all-weather portfolio? So when we think about this part, before we get into DD and risk management, we think about 3 parts. So the first one is balanced exposure. So balanced exposure, we're referring to the portfolio in general and the portfolio overall. And so just like you would with any other asset, we want to think about, what are your portfolio goals? What's your risk to reward profile? What are your return expectations? What's your vol? What's your Sharpe? What's your Sortino ratio? What are your liquidity preferences? Are you hedging anything, etc.? And then based on those high level questions, we can then start to go into, okay, on the left, we have traditional all-weather portfolio, but as we evolve into 2023 with everything that's happening, what percentage should I consider to be growth assets? What should be income or defensive assets? And then how are we evolving that for 2023 as we think about the percentage within growth assets, digital assets. And so just like we have these different buckets in traditional assets, we've also broken those out for digital assets. And so Andrew will speak shortly about diversification and the way that we think about allocating digital assets, not just as a percentage of your overall portfolio, but into each of these key buckets, like growth assets. We have stocks, real estate, venture capital, private equity, commodities, and digital assets. And you also have your defensive assets. Within the digital asset subcategories, we're going to get into more details. So I'm going to go through this rather quickly. But you have 3 main buckets of venture capital, blue chip, and liquid long. And then within the digital asset category, you also have a defensive or an income asset called USD yield. Now, in a traditional portfolio, currently that may fit into a growth asset, but as that matures, and we think we're kind of months away from that actually moving into more of a defensive and an income asset. And so I'm going to pass it over to Andrew, who's going to talk about diversification. Andrew, are you with us? You may be on mute.
You're on mute.
Indeed, thank you. So how do you get the risk-adjusted return benefit to your overall asset portfolio that we believe investments in digital assets can offer? Well, obviously you have to be long, you have to be exposed to the sector, but you have to do it, we believe, in a maximally diversified way. And that's because it is still extremely volatile. There are numerous tail risks. And while some of those we think are reducing over time as the space matures, nonetheless, they're very real. And they do pose an existential risk to many long portfolios that get exposure to this industry and this asset class. So what do you do about it? You diversify. And in particular, you diversify in terms of strategy. And we're going to go now into 4 different core strategies that give you a diversified portfolio. But I also want to remind everybody, we do this as funds of funds. We invest in underlying funds. And the reason we do that is because you can diversify in an entire additional layer when you have a fund of funds as versus when you have any single fund strategy. And you can invest in the best fund in the world. There's still going to be risks. And if that risk presents itself, in some cases, that could be an existential risk to your entire investment. Fund of funds are able to diversify that away by being invested across dozens of different underlying funds with complementary strategies, but with uncorrelated risks. So with that, I'll get into the first strategy that we think is meritorious, which is what we call liquid venture. Next slide. So liquid venture is what we believe is the best way to get venture capital stage exposure to the industry and the asset class. And we call it liquid because what we're getting when we invest in venture capital in the space is often company equity, yes, but even more often a token, a digital asset that is often fundamental to the functioning of a product that is launched on a blockchain protocol. And when that token is launched, you have liquidity. And so as an early stage venture capitalist in the space, you also have to be a liquid portfolio manager inherently. And that is a tremendous opportunity because it gives you optionality about taking risk off, doubling down, recycling that new liquidity into a new investment faster, et cetera. We pay attention to 4 things. We're investing in teams and technology, not in hype. And so even if we get the timing of the market wrong, if we invest in great teams and great tech, we think we're going to do well in the long run. We also do pay attention to the market cycles, as James said, and we've seen that historically in bear markets is when you get the best valuations in early stage venture deals, and therefore the best return when there's a liquidity event. Finally, we're cognizant of the fact that in this digital assets 2.0 era, we do see things being built on mature infrastructure, mature technology primitives that were frankly just not there in the last cycle. And we think that that stronger foundation offers even more potential upside from this digital assets 2.0 cycle. And then finally, we do believe the regulatory landscape is becoming quite clear. And that's evidenced by the fact that the largest asset managers on the planet are making big investments in the space. So we think the timing is good from all of these perspectives. Liquid venture, I just mentioned a little bit about how it works, but essentially it's the combination of venture capital with the liquidity optionality that you get from being a hedge fund, with the diversification risk mitigation that you get from a fund-of-fund structure. And that's how we've been able to outperform most other ways of investing in this space since our inception. Next slide. And most importantly, we think at the end of the day is your returns and your risk-adjusted returns. Again, if you get liquidity faster than you do in traditional tech equity venture capital, where you're waiting for an IPO or a buyout, perhaps 5 or 10 years after your initial investment, if instead you're getting that a year or maybe 2 after your initial investment because a token is fundamentally part of the product, and so you get liquidity as soon as a startup's product launches, then you can recycle that capital and increase your IRR inherently. Next slide. So we've done really well with this. We've won a lot of awards, and it is a strategy that will continue to run forever. But we think particularly at this inflection point moment, it's a very, very high risk reward, high reward to risk potential strategy for this point in the market cycle. Next slide.
Thank you, Andrew. So one thing that we really considered was the point earlier about fund of funds. We look at a few different areas. There's obviously tech we've referred to, but also hedge funds. When hedge funds became mainstream and we started to move away from humans trading to machines and started to look at different things like trading vol, etc., we noticed that the fund of funds model back in the early 90s was very popular because it was relatively newer to investors. They didn't have a full understanding, and they didn't want to have to go out and do all this diligence and understand all the technicals and the risk and all the different things about the different hedge funds. And so fund of funds became very popular. They created outsized superior risk-adjusted returns than stocks and equities and stuff because it was more nascent, but it reduced a lot of the risk because of the fund of funds approach. And so our idea with USD Yield was take a similar approach, complement it to what ChainLink had built with their approach around venture capital, and say, how do we allow people to come into the space where they can still benefit from the potential upside? Because in a bull market, these strategies still return 30, 40, 50, 60, 70%. But even in an average year, they're outperforming, with risk-adjusted basis, they're outperforming the S&P 500. And so the reason these opportunities exist is because the market is nascent, it's highly volatile. There is a demand for leverage in the blockchain and the digital asset space. There is structural inefficiencies, and there's a lot of innovation that is occurring. And so you're running traditional market delta neutral strategies that protect the downside with strong upside potential, but you're doing it across a diversified array of funds through arbitrage strategies, market making, liquidity providing, innovations like DeFi yield farming. And then you can also layer in delta neutral algorithmic trading if you want to get really sophisticated. And so just to show you what's possible with something like this, for someone who may not be in digital assets right now, maybe it's in digital assets, but wants a different form of exposure, is you can have an all-weather strategy that is going to benefit from volatility in bear markets and bull markets and sideways markets. The target return is 12-15% net, more in a bull market. You have 5+ sharp, less than 5 volt, greater than 9 Sortino, and you have less than a 0.15 correlation to stocks. Remember in 2022, bonds had 0.7 correlation to stocks. And so on the left, we've actually taken the data from our top 15 funds out of over 500 that we've vetted in the space, and we ran a hierarchical risk parity model, which focused on very low vol. And then on the right, we've gone for slightly higher returns, slightly higher vol with a Markowitz model, and you can see what's possible by moving across these different types of strategies. Outside of that, then you also have the blue chips. And once again, we'll share the slides for everyone after. We know we're going through kind of fast here. But with the blue chips, just like you can accumulate yield on USD, you can also accumulate yield, Bitcoin on Bitcoin, ETH on ETH. And so in the last 3 cycles, Bitcoin's been a leader. In the last 2, Ethereum's been a leader, because you have digital gold and you have the Amazon of decentralized apps. And what we see is in these markets, liquidity typically flows to these folks first. And so we're very bullish on Bitcoin as a store of value because of its inherent nature, that the actual fundamentals of it are significantly superior in terms of the number of factors to gold. So right now, sure, it's very volatile and it's not fully mainstream yet, but we think the makeup of it, and as it matures, it's going to get more and more in that place. So the first piece is Bitcoin is portable and it's accessible. Physical gold, it's very challenging to do that. It's divisible. It's secure. Blockchain is very secure, as long as you know what to do with it. There's limited supply, so as you know, we'll go into all-time holders, long-term holders shortly, but a lot of people are holding their Bitcoin. And so the more people that come into the space, there's only one place for the price to go. The second one is it's transparent and it's mutable. And then lastly, transaction costs are being improved over time. As well as Bitcoin, you also have Ethereum. And so Ethereum is a catalyst for decentralized applications. And so the intention of Ethereum, we'll get into more use cases and things later, is it runs exactly as programmed without any possibility of downtime, censorship, fraud, or third-party interference. So as Ethereum's apps are being built, and we've got AI that's trying to displace trust in a number of different areas, apps that can have no downtime or very little downtime, censorship, fraud, or third-party interference are very, very important to the future of the internet. And so in terms of the case for Ethereum and Bitcoin yield, this is the pro forma portfolio of the funds we've invested in, which are accumulating Bitcoin on Bitcoin, ETH on ETH. And so you're aiming for probably slightly less than what you would with the USD yield, but very similar. Across a 4-year cycle, if that continues, the goal is to 2x the amount of Bitcoin or Ethereum that you hold across a 4-year cycle. And this works for 2 different reasons. One is you can de-risk potential drawdown from the initial investment. So as you accumulate more Bitcoin, more Ethereum, even if the initial price goes down, you're reducing your risk. But then 2, if we do go into these larger cycles and we see price appreciation, you're now holding more Bitcoin and more Ethereum, and you can accumulate more upside. So it's a win-win on risk and reward. Back to Andrew for the final part around liquid long. And you're on mute again, Andrew.
Thank you. So we are partnering to launch early next year a final product in our collective suite, which we call Liquid Long. So ChainLink Capital's Liquid Venture Fund focuses on early stage pre-market assets that, yes, become liquid quickly, much more quickly than traditional technology equity venture capital, but nonetheless are only semi-liquid. Amphibian offers these blue chip yield generating products on top of Bitcoin and also on top of Ethereum and on top of dollars. What about this in between, where you have what was a venture capital type asset, not yet a blue chip, but already liquid? Well, if you do it right, the analog might be micro cap stock picking. If you do it right, the upside potential of those assets, given how early and under the radar they are, even though they're liquid, can be even higher than the blue chips. And so we're putting together a product that blends the best of what we already run in our existing portfolios to give you exposure to that segment, which we call altcoins, and to do it in a blended way, recognizing that it's different parts of the 4-year cycles of this industry. The blue chips will outperform, and in other parts of that cycle, if history is any guide, the altcoins will outperform. So the Liquid Long will be a one-stop shop to get exposure to Bitcoin with yield, Ethereum with yield, and altcoins, many of which will become liquid out of our early stage pre-market venture portfolio, and a one-stop shop to get all of that. Next slide.
Great. Thank you, Andrew. So one thing, we've probably got about another 10 minutes that we're going to go through here. Joe's asking about valuations. We'll get that into the end. If everyone just wants to put their questions in here, and we'll save a few minutes at the end to go through that. So thank you for all still staying here. So the final part of how we think about this is just like any other asset, thinking long-term, right? Back to the earlier points. It's very important to focus on trends, let go of the noise. And so all it takes is one killer use case, and we're going to see trillions of dollars moving into this industry. We already have players who are managing 36 trillion entering the space, and it's only a matter of time before trillions actually gets invested into the space. And so if you look at the case of Bitcoin, we've got this new all-time high with long-term holder supply already happening. So more and more people are holding Bitcoin. That means there's more players coming to the space. There's only one place for price to go. BCG has a report. They predict that there will be over 1 billion cryptocurrency users on top of other users of blockchain, et cetera, by 2030. You have similar things happening for Ethereum, where 2/3 of Ethereum have been holding for more than a year. And Ethereum actually has more long-term holders than Bitcoin. Ethereum is actually a deflationary asset now. So the number of tokens is actually decreasing over time. So price theoretically will continue to increase. And you've got this large technical shift happening within Ethereum, which is allowing, in the roadmap, we expect in the near future for it to process transactions faster than Visa. So as we get into the final part of this, we're going to go through risk management. We'll share our diligence process and we'll answer any questions with you. So just like you approach traditional assets, excuse me, there's kind of 5 key categories that we think about in terms of risk management within digital assets. 1 is valuations or strategy and trading risk. 2 is counterparty risk. 3 is cash and custodial risk, adding wallet risk within crypto. 4 is cybersecurity, and 5 is regulatory and compliance. We'd love to chat with you all one-on-one and individually to go through these in more detail and to explain how we think about it. But one of the unique things about the partnership we've been able to create with over a decade's worth of experience, myself in the digital asset space, plus the collective team in the ecosystem, is very sound risk management processes because we've learned so much from the space over the period of time. And so when we think about how to diligence funds, we'll send this to you so you can have access to it. But we've now got a process that eliminates 98% of funds. Very similar process to how we operate when we're evaluating VC funds. And so there's a scoring system, there's a bunch of data and a bunch of metrics that initially weeds out 80% of people. But then we go through a whole diligence process, including our 92-point integrity checklist, which I'll send you shortly, that really helps vet who is a real player in the space and who is not. And then we go through every possible scenario, looking at third-party verification, all these different things to go and make sure that these stand up. And then we usually start small and we expand with them over time to really make sure that it's going to make sense. The next step that we do is once we've vetted them, which we think eliminates a lot of the risk because we've got things right up front, is we then understand how well do they correlate to each other and how well do they correlate to stocks, to other assets, etc. And so we've been able to run thousands of simulations with our 2 quants and our team that can run all these different variations and understand what is the best risk-adjusted portfolio and how does it correlate to our other assets. Step 3 is that we then have a monitoring system. We have all of our top funds in a consortium in a group. We're actively looking and doing diligence together on different players in the space, different counterparties. We're also constantly staying on top of news and what's happening and where things are headed. And we're really uniting together around not necessarily edge or alpha in terms of trading, but we are looking at different counterparties and where the space is going. And this has been huge because now we can actually start to drive technological solutions. We are very close to working with a Swiss bank who will completely handle custody and be able to remove or largely mitigate a lot of the risk inherent in counterparties in crypto that will then get mirrored onto different crypto counterparties and allow us to have a solution that will finally allow true institutional money to flow into the space. The 4th one is a risk dashboard. So we work with a partner that has over 100 different dashboards to evaluate what's happening in the space. If key things happen, we get alerts so we can make decisions and move assets if we need to. And then lastly, through Amphibian Unite and all the different counterparties, over 500 funds with diligence and the ecosystem we've built, we're able to start to drive a lot of solutions in the space and help make it even more legitimate. So as we wrap up here, I'd love to hear questions in the chat. But the summary of this is based on historical cycles, we believe now would be the time to invest for superior risk-adjusted returns based on what we've seen in the past with all the players coming into the space, etc. And so it really leaves people here with kind of 2 options, or 3 options. 1 is to keep doing what you're doing. Option number 2 is to evaluate the space. And if you're evaluating the space, there's kind of 2 options. 1 is to go through this and do this yourself, probably make a lot of the same lessons that we've learned. We're happy to share a lot of our resources and things we've learned to help you and to support you and to help you diligence. We're here just to continue to support people in the space and to help grow the space. We're always here to serve and to help. So that's 1 option. I'll share my email below shortly for a bunch of resources to help you. Or option 2 is through one call, one diligence process between ChainLink, between Amphibian, we have all of your digital asset needs covered, whether it's USD yield, whether it's venture capital, whether it's liquid long, whether it's the blue chip, whatever it is, we can work with you to create something that will fit your needs and be your support in the digital asset space. And so the best thing to do would be we're going to put the Calendly link in here where you can book a time. For Arthur's audience, we decided, we don't typically do this, but we decided, just given the quality of people who are here, people in the space, Andrew and I would actually do an initial call together with you to support you, help understand your needs, enlighten you on the process around digital assets, review if you already invested in the space, looking to invest, etc., and then share more about what might be a good fit for you personally. So we'll share the link, and I'm going to share the diligence process. And then I know we have some questions. I'll pass it to Arthur, and if anyone else has any questions, feel free to share those in the chat. We'd love to answer them here for the last few minutes.
Yeah, super appreciate that extra effort there with allowing the community to connect directly, as you've suggested. Can we go ahead and answer Joe's question about the liquid long and how do you think about the valuations?
Yeah, do you want to answer that, Andrew? So he's asking, when thinking about liquid long, how do you think about valuations?
Yeah, so a couple things. One, we think that it's incredibly important to be discerning about what a early stage liquid asset is actually represents. So there are plenty of altcoins, so-called, which are purely hype and speculation, even today in what we believe is fast becoming the digital assets 2.0 era. However, what we draw our altcoin exposure discernment from is from early stage venture capital, where you're going deep with teams and technology before those liquid assets are created. And so we believe that we and our underlying fund managers that we invest through have strong discernment for the early stage liquid assets that have a not only viable but a thriving company, project, and or protocol associated with them. So it's the metrics about developer activity, it's the metrics about usage of the liquid asset that really matter. And so that's at least as important as looking at what the price of the asset is. So yes, valuation matters. Even better opportunities available typically during a bear market. The last thing I'll say is that on the other end of the spectrum, we have the blue chips, which have their own cycles, and we believe are an important complement of a liquid long strategy as well, because they are the, in some sense, the parking lot for the assets when you don't have the good altcoin opportunities available, and you want to be very discerning and selective about those, of course. And there are certain parts of the cycle where you will get the most risk-adjusted return from the blue chips, Bitcoin and Ethereum, and we want to be able to be agile and evolve, oscillate between those at different parts of the cycle.
One of the things that I was wondering about your robust due diligence process for the funds that you're reviewing eliminates a lot of them. Are you able to extend your reach for that fund into the investments that they make, that due diligence reach?
Yeah, so basically what we do, and Arthur, hopefully, I'm sharing the links with everybody here. Hopefully they're coming through.
Yep.
Are they going through to everybody?
Yep.
I just want to. Yep. So at least on the quant side, they're trading, making a bunch of different suggestions. If we choose not to invest in them, then we don't benefit from what they're choosing to do. But we do usually collaborate with them in some way, shape, or form, and more of that will be coming into our consortium group, where we can at least work together on driving technology solutions, custodian solutions, etc. I'll let Andrew speak to the VC side.
Yeah, so on the venture side, this is an open, blockchains are open public digital goods, we believe. They're open protocols, commensurate. Similarly, it only makes sense, and we believe you can only thrive if you're open and collaborative as a participant in the ecosystem. And so that's how we operate. We are extremely liberal and open about sharing everything we do, including with funds that we're invested in and funds that we choose not to invest in. On the VC side, we think not only do we get the benefit of investing through amazing managers that are the best in the world at diligencing early stage teams and technology and negotiating good terms, but also we contribute to those managers because we have the bird's eye view by diligencing literally hundreds of different funds about what is going on in different segments of this industry. And in many times a portfolio manager will be hands-on and heads down with their portfolio, helping them to succeed. And they need that forest for the trees perspective that can come from us being invested in them. So it's absolutely a two-way street of information sharing between us and the fund managers that we invest in.
Yeah, thanks for that.
So I saw another question, Arthur, if that's okay for me to answer.
Yeah, let me
Great.
go ahead and just spin it out. What are your thoughts or plans for investing in Web3 ventures based in Hong Kong and the EU markets where they're accelerating their regulatory clarity? Also, are you anticipating that after next year's election, the USA will have a clarity via Congress getting laws passed that will unlock the industry? Thanks.
I'll take a first stab and then pass to Andrew. So we intentionally set Amphibian up as an offshore BVI master, so we could invest outside of the United States. I just spent a month in Europe. I'm going to the Middle East in October, November, then going to Asia after that. There's a huge amount of activity happening outside of the US, and the space is flourishing. And so we intentionally said that, like, most of our managers, probably 80% of our managers, are outside of the United States on the Amphibian side. Passing it to Andrew.
Sure. And in terms of the venture side, we are invested directly with managers based in both Hong Kong and Paris and Sydney and elsewhere. And that's intentionally by design, because entrepreneurs are all over the world. And as the person who asked the question was alluding to, the regulatory landscape in many of those geographies has been more favorable than in the US, although we think the US is starting to really come around. So it is both a risk mitigation, as I've been talking about ad nauseum here, to be diversified across the different regulatory geographies of the world. And it is also important to capture the exposure to literally the best entrepreneurs in the world, because they do not, and if they ever did, they certainly do not anymore all reside in the US. The US remains a fundamental market for capital and a fundamental market for customers, but it is by no means has a monopoly anymore on the best entrepreneurs in the world, certainly not in digital assets.
Yeah, smart people everywhere. So this has been super helpful, and it's serendipitous that we've had this conversation when arguably this might be the best time for an entry point, right? So that's just an editorial comment by me, but it seems that way from the data that you presented. So super smart stuff, guys. Someone raised their hand, but would you please write it in the box? We haven't toggled the Zoom to have you speak. So if you want to ask a question, just put it in the box, chat box, or the Q&A. What's aside from having a conversation with you folks, everything is available for US investors?
Yeah, we have onshore feeders in the US. The Amphibian funds, the master is an offshore. I believe ChainLink is domiciled, Andrew, within the US.
Correct. Yep. And similarly, we have offshore feeders, so international investors can invest with us as well. Or
if you needed a tax blocker or something like that, right?
Yeah.
Super helpful. Nicely done, guys. It was a fire hose, but it was totally made sense. So thanks, James, for firing it out that way, and Andrew. All right, so we're going to wrap it up, and I thank everybody for being here and asking your questions. We'll make sure you get directly in touch, and thank you, James and Andrew, for offering to book calls directly with the folks from Family Office Insights. Super appreciate it. You want to wrap it up with a final comment?
Yeah, I'll share. I mean, I've been through 3 runs. I'm, always ready for the 4th. But the thing that is most important is these things don't happen overnight, and it's, the world is moving faster and faster, and with everything happening with AI, I've never seen such a rapid shift in how things are unfolding in the space. And it really feels like now is the time, and it's very exciting after going through a lot of battle wounds over the last decade.
Indeed. Andrew?
I just want to thank everybody for honoring us with your time and your attention, and also acknowledge you, frankly, for being here at a time when much of the world isn't paying, in the investment side at least, as much attention as we think they should, given the signals that we have from prior history. So you're ahead of the curve. Acknowledge you for that. And again, thank you for your time.
Yeah, super. Thank you again, guys, for doing this. And hopefully we can do it again soon. And thank you all for being here and sharing with us the only thing you can't make more of, and that's your time. Till next time. Thanks very much, guys. Really appreciate it.
Thanks, everybody.